Ladies and gentlemen, today I want to talk to you about one of the most striking moves I've seen in decades. The crash in the prices of gold and silver, the biggest drop in over 10 years. Many people look at gold and silver as nearly immutable, as the safe haven assets that will always go up in times of stress. But history teaches us something different. What changes is not just the value of the asset, but the underlying system. And when that system changes, so does the role of the asset. So let's step back, look at the big picture, and then zero in on what this move means and what you can do about it. Every market move, no matter how shocking, exists inside a much larger rhythm, a cycle that's been repeating for centuries. The recent drop in gold and silver prices, the biggest in over a decade, isn't an isolated event. It's a moment within a vast, unfolding sequence of cause and effect that links human behavior, money, debt, and power. Most people get lost in the short-term noise, the headlines, the panic, the emotion of watching something they thought was safe fall fast. But the real insight comes when you zoom out and look at the mechanics behind what's actually happening. Throughout history, every economy and financial system has gone through a series of predictable phases. It begins with productive growth, innovation, expansion, rising incomes. Then comes credit creation as people borrow against a prosperous future. Eventually, debt builds faster than income, central banks step in, and money printing becomes a tool to sustain what can't sustain itself naturally. This is the long-term debt cycle, and gold and silver have always responded to where we are in that arc. In the early stages of a cycle, faith in paper money is high, interest rates rise, and investors prefer yield over stability. That environment pushes gold and silver down because the opportunity cost of holding non-yielding assets increases. People ask, why hold gold when I can earn 4 or 5% safely? That's the surface level explanation, but underneath, something deeper is happening. Rising rates are not a cause, they are a symptom. They represent an economy transitioning from easy money to tight money, from abundance to caution. In that shift, liquidity shrinks, leverage unwinds, and the weakest hands are forced to sell. That's what we're witnessing now, not just metals dropping, but confidence itself being repriced. Gold and silver don't move in isolation. They are reflections of trust in governments, in central banks, in fiat currencies. When that trust rises, metals fall. When it erodes, metals rise. The irony is that the seeds of the next rise are often planted during the moments of deepest decline. The same tightening policies that crush gold and silver today often lay the groundwork for inflation and instability tomorrow. This is how the cycle breathes: expansion and contraction, hope and fear, optimism and doubt. If you only look at this week's chart, you miss the truth. But if you look across centuries, you see the same story play out again and again, from the Dutch tulip mania to the British credit boom, from the American industrial rise to the current global monetary experiment. The tools have changed, but human nature hasn't. We still chase returns when things look good and flee to safety when they don't. That collective swing of emotion creates the patterns we call cycles. Right now, we're in the tightening phase, the part of the long-term cycle where central banks fight inflation with higher rates. Liquidity drains from the system, and speculative excess gets punished. Gold and silver are casualties of that process. They're being sold not because they've lost value in the long run, but because in the short run, liquidity is king. Investors sell what they can, not what they should. Cash becomes desirable, yield feels safer, and real assets lose their shine temporarily. But history tells us this phase never lasts. Once the tightening pushes too far, economies slow, debt service becomes unbearable, and policymakers are forced to pivot. They lower rates, inject liquidity, and devalue currency to reset the system. That's when gold and silver reassert themselves not as investments, but as measurements of reality. Understanding this rhythm is the difference between reacting and preparing. When you view market through the lens of the cycle, volatility stops being frightening and starts being informative. You begin to see that each drop, each rally, each headline is part of a natural process like tides moving in and out. The wise don't try to fight the tide, they learn to read it. So when you see gold and silver plunge, don't ask, what went wrong? Ask, where are we in the cycle? Because if you can answer that, you'll know what's likely to come next. You'll understand that today's fear is tomorrow's opportunity, that short-term noise can't override the long-term laws of economics and psychology. This is how the great investors, the resilient economies, and the prepared individuals survive, by seeing beyond the moment, by recognizing the macro cycle for what it truly is, a mirror reflecting the unchanging nature of human behavior under pressure. The key is perspective. Those who master it aren't surprised by events like this, they expect them. They don't confuse a storm for the end of the world, they see it as weather, temporary but revealing. Because in the grand rhythm of markets, the drop in gold and silver isn't the end of a story, it's the midpoint in a much larger one. And when that story turns again, as it always does, those who understood cycle will be standing in the calm, ready for what comes next. There are moments in history when the assets we rely on to protect us stop behaving the way we expect. Gold and silver have always carried that aura of permanence, symbols of safety in a world of uncertainty. They've been the ultimate store of value when currencies falter, economies wobble, and confidence erodes. But every system evolves, and the roles of assets evolve with it. What was once the ultimate safe haven can, in certain moments, act like a risk asset. The recent drop in gold and silver prices isn't just a correction. It's a sign that the environment they exist in has fundamentally shifted. To understand why, we have to recognize that safety isn't an intrinsic quality, it's contextual. Assets don't become safe because of what they are. They become safe because of how people collectively perceive them. That perception changes as liquidity, credit, and policy shift. During times when central banks are expanding balance sheets and printing money, gold and silver tend to flourish. They serve as counterweights to paper currency and debt expansion. But when those same banks start tightening, when liquidity contracts and real interest rates rise, the dynamic reverses. Investors move toward yield, not protection. In that moment, gold and silver stop being sanctuaries and start being sources of cash. We've seen this pattern many times before. In the early 1980s, when Paul Volcker raised rates aggressively to fight inflation, gold crashed by more than half. Investors who thought they were holding the safest asset watched its price evaporate because the definition of safety had changed. Back then, safety meant owning dollars that yielded double-digit interest. Today, the mechanism is subtler, but the psychology is the same. When real rates rise and liquidity drains from the global system, the world's preference shifts. Safety becomes synonymous with liquidity, the ability to move, to adapt, to survive in a tightening environment. Gold and silver, which yield nothing, suddenly look heavy. They're sold not because they lost long-term value, but because they can't provide short-term flexibility. There's another dimension: leverage. Over the last decade, financial systems became addicted to cheap money. That cheap money didn't just inflate stocks and real estate, it seeped into every corner of the economy, including precious metals. Traders, funds, and even central banks built positions assuming that low rates would persist indefinitely. When the environment shifted, those leveraged positions became vulnerabilities, forced selling cascades, not because people stopped believing in gold, but because liquidity stress doesn't discriminate. In a liquidity crisis, people sell what they can, not what they want. Gold and silver are among the easiest to liquidate. The irony is that safe, haven assets often get sold first in moments of panic, precisely because they're among the few things that still hold value. This is the paradox of safe havens. Their protection depends on timing. Over the long run, they preserve purchasing power. Over the short run, they can amplify volatility. When everything's calm, people forget about them. When inflation rises or currency confidence erodes, they rush back in. But when central banks reassert control, even temporarily, those same people rush out again. What's really changing isn't gold or silver themselves, it's the trust structure of the financial system around them. When people trust policy, metals fall. When they lose trust, metals rise. That's the dance between fear and faith that has repeated for centuries. Today's world is more complex than ever. Digital currencies, algorithmic trading, and central bank interventions have created an environment where reactions happen faster than understanding. A decade ago, it might have taken weeks for investors to adjust to new monetary signals. Now it happens in hours. That speed magnifies every move, distorts every signal, and temporarily blurs the true role of safe haven assets. But underneath the noise, the fundamental dynamics haven't changed. Gold and silver still serve as the ultimate check on human excess, just not on the timeline most people expect. If you study history, you'll see this pattern clearly. Every empire, from Rome to Britain to the modern United States, has relied on sound money until it couldn't. Every time, the definition of safe evolved with the structure of power. In expansionary phases, safe meant yield and growth. In contractionary phases, safe meant tangible and real. The transition points the moments like the one we're living through are when confusion reigns. That's when safe haven assets appear to fail, when in reality, they're being temporarily repriced within a changing system. The mistake investors make is assuming that gold and silver have a permanent role. They don't. Their role depends entirely on where we are in the long-term debt and monetary cycle. When debt is expanding and inflation is feared, they act as hedges. When debt is contracting and liquidity is scarce, they act as funding sources. Understanding that duality is critical. It's not about worshiping the metal. It's about understanding the mechanism. What's happening now is a redefinition of safety itself. Central banks are tightening after years of expansion. Real yields are rising. Cash has a return again. In this moment, safety looks like liquidity, but this phase will not last forever. Eventually, the pressure of higher rates will break something, perhaps in credit markets, perhaps in sovereign debt, perhaps in currencies. When that happens, policymakers will pivot, they'll ease again, liquidity will flood back in, and the narrative will reverse. Gold and silver will once again become symbols of protection, not liquidation. The lesson isn't to abandon safe haven assets or to idolize them. It's to understand that their role is cyclical, not constant. They don't fail, they adapt. And those who can see the shift, who understand when safety changes shape, are the ones who survive the transition. Because in markets, as in life, what protects you in one phase can hurt you in the next. Wisdom lies in recognizing when that shift occurs and adjusting before the crowd realizes it has happened. Every major financial event in history, whether it's a boom or a crash, eventually comes down to the same forces: liquidity, interest rates, and real rates. These three elements are like the blood flow, pulse, and pressure of the global economy. When they move together, when liquidity tightens, nominal rates rise, and real rates turn positive, the entire structure of markets begins to shift. What looks stable starts to crack, and what looked risky starts to become necessary. The recent collapse in gold and silver prices is not random. It's the consequence of these forces converging at the same time, reshaping the financial landscape underneath everything we see. Liquidity is the oxygen of markets. It's what allows money to move easily from one asset to another, from one sector to Another, without friction. When liquidity is abundant, everything floats, asset prices rise, leverage expands, and even weak ideas find support. But when central banks decide to drain liquidity, that oxygen starts to thin. Suddenly, the air feels tighter. Prices start to suffocate, not because the assets themselves changed, but because the environment around them did. That's what's happening now. The central banks of the world, led by the Federal Reserve, are pulling liquidity out of the system to fight inflation that was created by years of excess money creation. They're not just raising rates, they're reversing the very conditions that inflated global markets for more than a decade. Interest rates are the price of money. For over a decade, that price was near zero. Money was free, risk was cheap, and everyone, governments, corporations, consumers, borrowed aggressively. When money is free, people stop thinking about its value. But when rates rise, the world remembers that capital has a cost. The adjustment is painful because every valuation, every assumption is built on what rates were, not what they are becoming. As central banks raise rates, the cost of capital resets. Assets that once looked attractive become liabilities, and the repricing process doesn't happen neatly. It happens violently as liquidity and sentiment collide. Then there are real rates, interest rates adjusted for inflation. They're the truest measure of how attractive holding cash really is. When real rates are negative, as they were for much of the past decade, holding tangible assets like gold and silver feels smart. You're not earning yield on cash, so you'd rather hold something real. But when real rates turn positive, when the return on safe government bonds exceeds inflation, the equation flips. Suddenly, investors can earn a real return without taking risk. In that environment, the non-yielding nature of gold and silver becomes a burden. The same forces that once drove them, higher inflation, uncertainty, weak currency, lose their power. Because the system now offers a viable alternative, this convergence of tightening liquidity, rising nominal rates, and positive real rates is rare. It doesn't happen often, and when it does, it reorders everything. Think back to the early 1980s Volcker's America. Inflation had spiraled, and the Fed crushed it by pushing interest rates above inflation. Real rates turned positive for the first time in years, and gold, which had surged to record highs, collapsed. It wasn't that gold had lost its long-term value, it was that the environment changed faster than investors could adjust. That same dynamic is unfolding again. The modern version is more complex, layered with global debt, derivatives, and interconnected markets, but the core mechanism is identical. Liquidity drains, capital costs rise, and real returns pull capital away from hard assets. There's also a psychological element. Liquidity creates confidence. When it's abundant, people believe in the system. They take risks, they borrow, they speculate. When it tightens, fear spreads. Investors sell not because they want to, but because they have to. Margin calls, redemption pressures, collateral demands, all of these accelerate when liquidity dries up. It becomes a chain reaction, and in those moments, even assets meant to protect you, gold, silver, commodities, get sold. It's not about belief or disbelief in value, it's about survival. This phase always feels chaotic, but it's a necessary part of larger cycle. Tightening cleanses excess. It punishes overleverage, restores discipline, and resets valuations. But it's also transitional. No system can endure high real rates indefinitely. Debt burdens grow heavier, growth slows, and pressure builds. Eventually, the very tightening that crushed markets creates the next loosening. Policymakers pivot, liquidity returns, and real rates fall again. That's when gold and silver reawaken, often stronger than before. The seeds of their next rally are being planted in the soil of today's decline. Understanding this convergence is about seeing cause and effect machine that drives markets. It's not emotion, not conspiracy, not manipulation, it's the mathematics of cycles. When liquidity, nominal rates, and real rates align in a tightening phase, they draw value back into the center of the system. When they diverge again, when liquidity expands and real rates fall, value flows outward into tangible and scarce assets. The key is knowing which phase you're in and preparing for the inevitable transition. Right now, the world is living through the hard part of the cycle, the squeeze. But if you understand it, you won't be surprised by it. You'll recognize that these pressures are temporary, that what feels destructive is actually preparatory. Because the moment these three forces begin to separate again, when central banks blink and liquidity returns, the same assets being punished now will become the refuge once more. Wise don't fight the convergence. They anticipate its reversal. That's where real wealth is built, not by reacting to noise, but by understanding the deep mechanics of how the system breathes. The most dangerous thing an investor can do after a sharp market drop is to focus on what just happened, instead of what comes next. It's easy to get lost in regret, frustration, or fear when prices fall and portfolios shrink. But history doesn't reward reaction, it rewards preparation. Every downturn, every dislocation, every painful correction carries within it the seeds of the next opportunity. The challenge isn't surviving the past, it's positioning intelligently for the future. The people who emerge stronger from moments like this aren't those who predict every move correctly. They're those who think in probabilities, adapt quickly, and stay emotionally neutral when others can't. When gold and silver collapse after a decade of faith in their strength, it feels like the system is betraying its logic. But that emotion, that sense of disbelief, is part of the process. It's the emotional tax investors pay when cycles turn. What's really happening beneath the surface is a rebalancing of expectations. Markets move from one extreme to another, from optimism to pessimism, from excess to scarcity, and in that swing, they reset the foundation for the next phase. The people who look beyond the immediate pain and start asking the right questions: what is this setting up? Where are we in the cycle? What does this make possible? Those are the ones who position themselves correctly for what's coming. It starts with clarity. The purpose of understanding cycles, liquidity, and rates isn't to sound smart. It's to build perspective. Perspective creates distance from emotion. When you understand that market crashes are natural outcomes of prior excesses, you stop treating them like accidents. You realize they are necessary adjustments, the system's way of cleansing itself. From that vantage point, you can start thinking constructively. Instead of asking, "How much did I lose?" you start asking, "What does this environment favor next?" That's where power begins, when emotion gives way to logic. Positioning well means understanding the trade-offs. In tightening cycles, safety shifts from yield to liquidity, from speculation to stability. But as those pressures peak, they create distortions, undervalued assets, mispriced risks, and neglected opportunities. Gold and silver falling sharply, for example, might signal the beginning of a phase where hard assets become attractive again once real rates peak. But to benefit from that, you need to think 2 steps ahead, not react to the drop, but anticipate the recovery. Most people wait for proof, the prepared act when probabilities shift in their favor. That doesn't mean guessing the bottom. It means building flexibility so you can move when the environment changes. Flexibility is often more important than precision. The best investors don't try to call exact turning points. They design portfolios that can survive and adapt across multiple outcomes. That means balancing deflationary risks with inflationary hedges, pairing cash reserves with productive assets, and keeping dry powder for dislocations. It's about creating a system that thrives not because it's right all the time, but because it doesn't get destroyed when it's wrong. In a world where shocks happen faster and information moves instantly, adaptability is the new form of intelligence. But positioning isn't just about portfolios, it's about mindset. When fear dominates the headlines, instinct is to contract, to pull back, to retreat, to wait for things to stabilize. Yet markets rarely reward those who wait for comfort. Stability returns after the opportunity has passed. The discomfort, the uncertainty, the sense that it could get worse. Those are the emotional markers of a turning point. If you wait for clarity, you'll miss the reversal. The goal isn't to eliminate risk. It's to take risk intelligently, aligned with where the probabilities are shifting. We are in a moment when the global system is recalibrating, liquidity tightening, credit contracting, real rate rising, and faith in certain assets being tested. But that same process creates future asymmetry. The assets being sold now will become tomorrow's bargains. The economies slowing today will be the ones that recover strongest when policy reverses. The pain investors feel today will become the entry point for those thinking ahead. That's the rhythm of every cycle. The question is not whether this time is different. It's whether you're ready to see the pattern through the noise. What separates the few who prosper from the many who panic is discipline. Discipline to detach from the herd, to think independently, to act on fundamentals instead of emotions. It's not easy, it never is, because when the crowd is fearful, being calm feels wrong. But the data always follows psychology: capitulation first, recovery later. Those who understand that dynamic can use fear as information. They can recognize that when everyone else is reacting to what just happened, the real opportunity lies in what's about to unfold. So instead of despairing over falling prices, study what those prices reveal. Ask what they're discounting, what they're signaling, what they make possible. The worst moments in markets often coincide with the best setups for those willing to think long term. If you can hold that perspective, if you can train your mind to look beyond the immediate pain, then downturns stop feeling like punishment. They start feeling like invitations. Because the truth is, every great cycle begins the same way, in disbelief. After the crash, when confidence is shattered and faith is scarce, the foundation for the next era of growth begins quietly forming. Those who are ready, who position not out of fear but out of understanding, are the ones who capture it. The goal isn't to survive the past, it's to prepare for the future that the past is creating right now. In closing, the drop in gold and silver is not simply a bad day for precious metals holders. It is a wake-up call for all investors. It is a reminder that the world is changing, that financial systems, currencies, and asset roles are under pressure. If you ignore the signal, you may be blind-sided. If you heed the signal, you may be ready. Rethink your assumptions, re-examine your portfolio, and don't assume that just because gold and silver have held up historically, they will do so in exactly the same way in the future. Because the future is never the same as the past. But by studying the past, you improve your odds of recognizing the future. Thank you for listening. I'll see you on the other side of this cycle.